Hello, everyone. Good afternoon. Good day on this beautiful Sunday. How's everyone doing? Looking forward to another productive session and another good week of trading ahead. We have an interesting week ahead of us, a lot of factors with the economic calendar and geopolitical events around the world that we'll cover and get into before we start looking at the technicals so that we can have these dynamics at the forefront of our mind while we're navigating this week, so we can keep in mind to respect the risk in these underlying conditions, as well as know what to expect moving forward. So with that being said, thank you all again for joining us and sharing your time with us this Sunday. I'm looking forward to getting down to business. So my name is Dylan. I'm a professional trader through True Forex Funds, and I am a specialist in the S&P. However, we do a top-down analysis on the dollar index, the bond market, as well as the interest rates, so that we have a clear idea of what to expect going into this week. So with that being said, I'm going to pass it on over to my associate Tommy, and then we'll get right into what we're expecting for this week.
Hello, good evening, everyone. My name is Jonathan. I'm a professional trader and I trade with True Forex Funds. Beautiful and lovely to have us once again in this live session call. We're looking forward to an interactive session with one another. Let's have a good and lovely time together. Thank you very much.
All right, so let's get right into it. So what I'll be expecting for this week and what we'll be looking for in terms of my expectations and what I'm anticipating, we'll cover that a little more. I do want to preface everything we'll be saying today and what we'll be looking at under the pretext of the conditions that we're in right now worldwide as traders. So, we're seeing a lot of events with the financial system here in the United States. We're also seeing things around the world with the escalation of the WAR that's going on in Europe right now. So I do want to touch on a few of these factors. I do need to keep in mind this is a YouTube broadcast, so I do need to be careful with how I say specific things. However, these are things we need to be mindful of as speculators and traders. So one thing I do want to discuss is that what I'm thinking we're seeing is a systemic meltdown of the financial system, and this is being reverberated in the marketplace. And what I mean by that is we're seeing a lot of smaller regional banks in the United States do not have the necessary liquidity to give to withdrawals to their clients. And we're seeing multiple mega banks, namely JP Morgan, Goldman Sachs, a lot of big banks are now giving, I think in total, 30 billion to these smaller banks so that they're able to cover their withdrawals, as there's many people outside of these banks in lines that wrap around the buildings to get their cash out, and unfortunately these banks don't have it. So what's being done is these bigger mega banks are actually supplying the liquidity or the cash needed to these smaller banks so that they're able to cover their withdrawals, and we're seeing this phenomenon perpetuated throughout the United States. Another thing that we're also seeing, in my view, is a consolidation of the banks. We're seeing smaller regional banks are actually getting bought up and consolidated into the bigger banks, being mega banks, for example, JP Morgan, UBS, Goldman Sachs. They're starting to accumulate these smaller banks. And what it is that I'm interpreting this as is we're seeing a consolidation of small banks into big banks because the big banks are willing to play ball in this digital system that's coming. So it looks to me like these smaller institutions are being terminated. So that's what I'm seeing in terms of the financial and economic situation here in the United States. And this is obviously reverberated through the marketplace. Any of you guys that have been paying attention to the markets, you've been seeing the bond market has been going crazy. And that's in response to a lot of these things that we're seeing worldwide. So with that being said, it's important to have these things in mind and respect the underlying risk that we're currently in. There's much more risk than there has been before, and that's important to be mindful of. We also have FOMC this week, and there are a lot of eyes on FOMC. So I will not be expecting much movement ahead of this rate announcement event unless something happens, obviously, outside of that. So I won't be expecting much movement ahead of FOMC. As ahead of rate announcements, FOMC, NFP, CPI. These are news reports that there's typically a consolidation ahead of, because big money will typically not position themselves ahead of news drivers like this, So they'll typically exercise patience as we go into these news drivers. So these are all things to keep in mind and have in the forefront of your attention as we navigate this trading week. So with that being said, I'm going to pass it on over to my associate, and then we'll get right into the technicals of what we're seeing and what we're expecting this week.
Well said, William. Uh, Basically, just as Glenn has said, I'm very minimal with the way I say things, but as Glenn has said, and I've been seeing in the charts, basically, um, we are sort of dangerous and, way I say, delicate price and moments in history, basically, due to the uh, recent developments in the financial system, especially in the European banks and the United States banking system. And this, as William has said, I'm actually an economist. That's my major in school. And with this, we have actually seen some crazy movement and volatility.
Okay, is this better? Can you guys hear me now? Okay. All right. So we got the technical side straightened out. Okay. So I'm going to go ahead and briefly summarize what Tommy was saying. So he's saying he's an economics major, and he was also confirming what it is that I was saying. As you know, he's my associate, so we were discussing ahead of this meeting what we're seeing more on the economic front and how this is impacting the marketplace and how we are seeing these reverberations inside of the financial markets. So with that being said, we have to respect the underlying risk that we're seeing in the markets with all the geopolitical events as well as the effects that we're seeing that the financial system is having on the marketplace. So we are seeing quite a bit of lack of confidence in the financial system. As I was saying, that we are starting to see the beginning of a systemic meltdown in the financial system. And we are seeing these effects reverberated in the marketplace. So now that we got the audio straightened out, okay, so we should be good to go. Okay. All right, so looking at the dollar right now, just to highlight what it is we've been saying in terms of the charts and how this is shown in the marketplace, we are seeing the dollar has taken quite a big of a hit. One thing I did want to highlight is gold and crypto. So we have been seeing gold has been ripping higher, as well as silver. That's oil, as well as the silver markets. And we've also been seeing Bitcoin and Ethereum catching a bid and rallying. So why are we seeing this in these safe haven assets that are outside the dollar? Well, if we look at each of these assets, they're denominated in dollars. ZA USD, gold US dollar, Ethereum versus US dollar, Bitcoin US dollar. So these assets are priced in dollars. So as money is losing or smart money or high net worth investors are losing confidence in the dollar, they're going to look to put their money to work in assets that are not the dollar. So we're seeing money leaving the dollar and going into assets outside of that, being Bitcoin, silver, gold, and we're seeing that money flow out of those assets into these assets that are a safe haven against inflation and lack of. Is the audio good? Okay, so the audio is good. Okay, awesome. Thanks for the feedback. Thanks you, Chin, and thank you, Savio. I really appreciate it. So, okay, yep. So as I was saying, so we're seeing money actually leave the dollar and go into assets that are denominated in dollars. So we're seeing how these fundamental drivers are actually shown in the marketplace. Okay, awesome. So now doing our top-down analysis, starting here in the dollar index, starting from the monthly chart, as we've seen a strong reaction higher off this monthly fair value gap. So this candle closed very bullish for February. March candle is actually starting to trade lower. If we get below this order block, more specifically the opening price, that would be problematic for continued bullishness. I personally, looking at the higher time frames, am still leaning towards bullishness in the dollar. However, looking at the daily chart, we are at a level that puts me at 50-50, and I'll highlight why it is that my analysis is conflicted and what I will be doing into this week to get confirmation for what it is I will be expecting. So now dropping down here into a weekly chart. Not much here on the weekly chart that I'm seeing. If institutional order flow is to remain bullish on a weekly chart, we should continue trading higher up through up close candles. So these up close candles here, here, and here should not be a factor, and price should continuously gravitate towards those. On a weekly chart, what would be problematic for bullishness for me would be if we start trading through these down close candles with speed, more specifically the consequent encroachment of this wick. So if we get below the 103.82082 level, that would be alarming, and I may have to just switch bias and potentially look for lower prices on dollar. However, I am personally favoring bullishness. Okay. Let me know if the crosshairs are better in terms of where I'll be referencing. So this is the consequent encroachment of the wick I was looking at. The 103.082 level. This is the level on a weekly chart that I would not want to see violated. Another reason for that is that it's a balanced price range. It's a balanced price range because we've delivered higher, we've offered sell side, buy side, and then we've left that range. So for price to come all the way through this efficient delivery would not bode well for bullishness. So I would want to see these levels stay intact and continue bullish if we are to remain bullish on the dollar. Now, the daily chart is where my analysis gets a bit conflicted, and this is what creates the 50-50 environment for me. And then as we've discussed before, whenever we have a 50-50 environment and there's not as much clarity, I don't want to, go in market open on Monday and just start placing bets. This could happen, this could happen. We need to define high probability, wait until what we're seeing becomes clear and know what the draw on liquidity is. And if that's not defined, then it's not trading, it's gambling. So the reason my analysis is conflicted here on a daily chart is that, so we've satisfied the upside objectives that we've shared with you all, being this volume imbalance in here at the 105 level and the up to the 106. So we've taken out this buy side liquidity and have rebalanced these inefficiencies. And then after we've done that, we've seen price has dropped off. So we have traded down to a discount of this dealing range here from this low to this high. Price has traded down into a discount. So what I did like to see at the beginning of the week was I was potentially thinking, okay, we're going to see a bullish week. Price is traded lower now into discount. The specific levels are the bullish order block. So this is our bullish order block in here, the high and the opening price. So price has hit that level and then has bounced. So I was thinking, okay, the price was just offering discount for reaccumulation of longs to then go higher. But then we see that price is now respecting these premium arrays. So we have traded down into the order block and a fair value gap. And let me mark that out here. So very small fair value gap, but it is a fair value gap nonetheless. So those two black lines inside of the bullish order block. So we have two discount arrays there that we would expect to support price if we are bullish. So what makes my analysis conflicted? So that, because right now looking at this chart, I could justify longs and shorts, and that is not high probability. So I did want to see price come down to these discount levels and continue rallying higher. But what we did is we came down to those levels, retrade it to a premium, and then we rejected this balanced price range, which is the overlapping of the sell side imbalance, buy side inefficiency, and the buy side imbalance, sell side inefficiency. That's a mouthful, but it's just two overlapping fair value gaps. We've traded up into that level, and then we've traded down off it, down into a discount volume imbalance. So let me mark that here. Okay, so we've traded down from the balanced price range down into the volume imbalance, and we are now in between two key PD arrays. So this is why my analysis is 50-50, because I could justify shorts off this balanced price range, and I could justify longs off these discount key levels. So what that does is that puts me in a neutral position. I do need to wait for more price action. So I'll demand more intel before I'm able to have a hardline bias and have the directional clarity we typically have. Okay, Jimmy, yep, I see your question. So why would I use this as the dealing range instead of the extreme low? So one thing I'm actually going to do a little teaching on dealing ranges and how to look at them top down. But one thing to keep in mind is there's price swings within price swings. So you could measure this as a dealing range, and that would more likely be associated with the weekly chart. But looking at it on a daily chart, this price run from low to high was done in two stages. It was done from this low to here, and then we've had a second stage of the price leg from this low to this high. So whenever you're measuring the dealing range, depending on what time frame you're on, you want to do the most recent one, as there's multiple price legs within price legs. So it really depends on the time frame. But as I said, I'll cover a little teaching here in the ES of how I use dealing ranges top down and how to calibrate them to the respective time frame that you're looking at. So that's why I'm using this low, because this low has taken out sell side liquidity and this high has taken out buy side liquidity. So this is a complete dealing range. So this is how I'm able to use my premium and discount levels to determine discount and premium arrays for the dollar index. So what will I be looking at in this coming week to get the clarity that I want on dollar, so then I can get back to a point of having a bias and directional clarity? So being that we're in between two premium and discount levels, I will want to see how price reacts at certain levels and measure the order flow. So what does that mean? So assuming we get an opening on Sunday that's near the close, if price trades down through these key discount levels, being the order block and the fair value gap, as well as the volume imbalance in here, that's now 3 discount arrays that have been broken. And as many of you guys know that study ICT, if 3 discount or premium arrays are broken, it's likely that the idea you have is invalidated. So as long as we remain above these key levels here for me, I will anticipate bullishness, being the volume imbalance, the fair value gap, and the order block. So assuming price finds support in these levels and rallies higher, that's what I favor seeing and what I'm anticipating. The reason for my conflicted analysis is the reaction we had off this balanced price range. So assuming we continue accelerating to the downside and we trade through these key levels I've outlined, then I will switch my bias and just simply get in line with the order flow that we're seeing, which would then show risk on. So that's what I'm seeing here on the dollar index. So I'm going to wait to see how we open on Sunday, how we trade overnight in the London European session, and then that'll give me the clarity I need going into the week in terms of what to expect for order flow. But these are the specific factors I'll be looking at to determine this. So on the upside, assuming we find support inside these discount levels, I will want to see price rally through the balanced price range, through the bearish order block, and continue rallying towards the premium objectives. So that's why my analysis is a bit conflicted and what I will be looking for. So now looking at the bond market, bonds have been moving quite a bit. So here, let me take off my markups and then we can look at it with a fresh set of eyes. Okay, Jimmy. Yep, glad that helped, brother. Thank you for the question. So Jonathan, you were asking regarding the order block and why I chose that one and not the ones beside it. Let me go ahead and cover that real quick, because I'm sure multiple people have that same question. Okay, so you were asking why just these 2 levels and not the entire body and wick. So the 2 sensitive price levels on any order block will be, or specifically on a bullish order block, would be the high of the candle and the open. Those are going to be the two most sensitive levels. And then obviously the mean threshold, which would be the 50%. So those are the three critical levels of an order block. More specifically, if it has a long wick, then we would use the high and the open of the candle. If it's a big body candle, then we're going to typically use the mean threshold. So that's how you can know what key levels to look at in the order block, and that's something there for your notebook. Going into the bond market now. Awesome. Glad that clarified that for you, Jonathan. Thank you, sir. Okay, so looking at the bond market right now. So I was favoring lower prices on bonds. As I showed you all with the 10-year yield, this is the T-bonds. So this is just going to be an inverse of the 10-year yield, which is what we were looking at. The reason I'm starting to look at this one a little more now is the intraday price action is more clear and it's not as spotty as on the interest rates themselves. So we were looking for acceleration on the downside to take out these relative equal lows. But what negated that? The fact that we found support inside of this bullish order block. And then as we just covered, why would we use the wick? Because it's a big wick order block, not a big body. So we're going to use the high and the opening price as the sensitive levels. So we see price traded into here, and then we see a strong reaction higher, bullish. So what I will be anticipating is for these relative equal highs to be taken out in a premium, and measuring the dealing range we're in now. We haven't really gotten much delivery above premium. We have wicked above it a few times. So I will want to see how we trade above these key levels. So my bias going into this week for bonds will be favoring a sweep of this buy side liquidity. But then what I'll be interested to see is how we trade at those levels. Do we sweep the liquidity and then drop lower? Or do we run the liquidity, meaning do we run through it and continue rallying? So that's what I'll be looking for the bonds to measure order flow on a weekly basis. And then we do have key premium levels here that we could monitor. The first one being the implied fair value gap here with the consequent encroachment of this wick and this wick. So that would be our first premium array. And then we have a fair value gap above that. So we have several premium arrays that I will be monitoring going into this week to measure the order flow and see how price trades at these key levels. So dropping down into a daily chart, now here we see these relative equal highs much more clearly. So take off this is the weekly order block we were looking at, and then we will just refine our PD arrays as we go down into the time frames. So now looking at this level, we have a fair value gap in here, and we want to measure the consequent encroachment of this fair value gap. So that would be the 122.30 level. Okay, so this black line will represent the consequent encroachment. So we see price traded down into this level, and the fact that we did not go below consequent encroachment was problematic for shorts. So we did find support inside of the upper half, and that is indicative, that's an algorithmic signature that price is bullish. The fact that it was not willing to deliver to the discount end of that fair value gap. So the fact that we rallied off the consequent encroachment 50%, we've seen a lot of bullishness higher. We have a breakaway fair value gap here, which is a fair value gap that was not filled in. And then we've been seeing bullish order flow on a daily chart. Here we have a volume imbalance that price found support in. And then we've rallied higher off that. And then now we also have a bullish order block. So we've seen prices hit that bullish order block twice, and then we have found support. So I will remain bullish on the T-bonds as long as price remains above this bullish order block, and I will be favoring delivery above these relative equal highs to attack that buy side liquidity. And then as I've said on a weekly chart, what I'll want to monitor going into this week is how we trade above these highs. Do we sweep them and then immediately displace lower and give a market structure shift? Or does price continue running higher and show continuous bullish order flow? That's what I'll be monitoring. So going into the week, I will favor higher delivery on the bond market. which will put pressure on the dollar index. Something that is interesting to note, though, is we have seen a strong move higher on the bond market, and we have seen an unwillingness of the dollar to drop lower. So, what this looks like to me is the banks are holding the dollar here at this level and not allowing it to drop lower, because assuming the market symmetry is present, with bonds rallying so much, that should put pressure on dollar, but we have not been seeing that. So that's something interesting to note going into this week. So as I've said, on bonds, my upside objective will be these relative equal highs. And then once we get there, I will determine how price is trading and what it is that I'll be looking for going into the latter part of the week, going into the following week. Right into the index markets. Start from the 3-month, do a little long-term outlook real quick. Okay, so looking at the ES on a 3-month time frame, which is a super high time frame, we are seeing price rejecting premium levels. So here we have a fair value gap here. We see price is unable to get above it. It's getting very weak in these levels. What else do we have? We also have an implied fair value gap here with the wicks at the 4403 level. And that is the 4140. Okay, so now that we have our implied fair value gap marked out here, we've seen prices traded into it once, rejected, traded into it once more, and we are seeing a rejection off that level. So we would treat an implied fair value gap the same way we would treat a regular fair value gap. So we're going to want to look at the consequent encroachment levels to get a feel for the weakness or strength of the underlying asset. So we are seeing price was unable to rally to the 50% of this level, and price is getting weak. So on a higher time frame perspective, I am seeing bearishness being shown. So that's what I'm seeing here on the 3-month. So assuming we do reject these premium levels, being this fair value gap and implied fair value gap, this fair value gap would be an inversion because we're now below it, so it could act as resistance, as well as the implied fair value gap. So assuming we reject these premium levels, where would it want to gravitate to? Discount, which would be below equilibrium. What key levels do we have below that? We have a bullish order block. So assuming we continue bearish on this 3-month time frame, I will anticipate delivery down into this bullish order block. Right into a weekly chart now, and now we'll go back to the official June contract, June delivery. Looking on a weekly chart. So looking at last week's delivery, we did have an expansion lower, and we did almost meet this low. So now we have relative equal lows on a weekly chart. And then after hitting those lows, we then rallied higher. Where did we rally higher to? Into this bearish order block here on a weekly. So price is traded into the opening price of the bullish order block. And just to confirm what we were discussing earlier, why would we look at the wick as significant? Because it's an order block with a big wick. So we're going to look at the low and the opening price of that order block, and then we see a nice reaction off that level. So on a weekly chart, assuming bearish order flow is going to continue, this up close candle should not be violated, and we should continue delivering through the down close candles that we are seeing on a weekly. So for me to remain bearish on a weekly basis, we should reject this order block and continue delivering lower to the discount objectives, being the sell side liquidity in discount, because the market efficiency paradigm states that smart money sold to these buy stops in premium, and now they're going to want to cover those shorts in a discount to the willing sellers at a cheap price. And so, yeah, we are seeing bearish order flow on this time frame. We do have a volume imbalance in here that price was traded up to, and then we rejected that. So I'm anticipating that to continue. However, if we are going to be bearish on indexes, dollar must play. Assuming the dollar goes lower and the conditions I was outlining manifest into a lower dollar, then we would have to reevaluate on the indexes. So as I've said, I'm 50-50 on dollar, which doesn't give me that high probability risk on, risk off. You guys see us calling these markets for you here on a weekly basis with high probability, high accuracy, and consistency. And that's because of the intermarket analysis that we integrate and use for our analysis and pre-market prep concepts. That's how we're able to have these high probability analysis. And when these things are in agreement, our probability drops drastically. So that's why I'm very hesitant to have a hardline bias going into this week. And I will just demand more information. And there's times as traders where we don't always have the clearest idea, and we just have to sit on our hands and be patient and then wait for more intel and allow the market to show its hand. And those are one of the times we're in right now. As with the conditions that we're also in, with geopolitical events, with the financial system, now is not the time to be in a rush to go in there and place your bets in the market. Walter, to answer your question, so consequent encroachment, so the question was, so is consequent encroachment 50% of the candle body? So whenever you're measuring candle bodies, that would be mean threshold. Anytime you're measuring an efficiency or a gap, you call that consequent encroachment. So remember, wicks are gaps. So every time we measure the 50% of a wick, a fair value gap, a volume imbalance, a new week opening gap, those would all be called consequent encroachment. So now dropping down into a daily chart for the ES, we've been seeing bearish order flow. As we highlighted to you all last week, we had basically the 2022 model, buy side liquidity taken, displacement, market structure shift, price traded back up into the premium as we expected, and then we rejected these nested premium arrays here and then attacked the sell side liquidity here below these lows. And then we delivered into the mean threshold of this order block that we were looking at as a downside objective. So something to note is that price was unable to close below the mean threshold of the bullish order block, which is significant. So let me mark out this mean threshold level. Okay, so here we have the mean threshold of the order block. We've seen the bodies were unable to close below this level, which signals that we are likely to see a higher retracement, which then we did see that going into the last half of the week. So price has now traded up into a premium of this dealing range here. The most recent price leg that we're in. Price is delivered to premium, and last week I highlighted to you all the key premium levels I would be looking at, which is the bearish breaker, the fair value gap, as well as the volume imbalance. So this is what you would call nested PD arrays. Nested PD arrays are simply PD arrays that are nested within each other, and that's a likely level that the market will want to reprice and redeliver to. So the reason I plot all these levels on the chart is to show the respect for these key levels. As we see here, the bearish breaker that we had our attention on this past week, price was unable to close above this level. So this was a valid target for Thursday's upside trading to the bearish breaker into the fair value gap in here. And we see price was unable to rally through that consequent encroachment. So one thing I did want to take our attention to is the wick on Friday. Price opened and then we trade higher. and we trade to close in this volume, not volume imbalance, this fair value gap. If we look at the low up here, the low of this candle is 4009 and 1/4. If we look at the high of this candle right here, it is 4009 and 1/4. And they will say the markets are not algorithmically controlled. So we've had a complete closure of this fair value gap to the tick, and then we've seen a rejection of these key levels. What's significant about this is no bodies were able to close above the bearish breaker or the volume imbalance. So we have rejected these key levels, and assuming we do, David, yeah, it's definitely just buying and selling pressure, man. The bears just took control right there. So what's significant about this is the bodies were unable to close above these levels, and we did see a rejection. So now that we have clarity of what happened going into the previous week and we have that context behind us, now how does that help us with our projections going into this week? So I am personally favoring lower prices on the ES as long as I've covered before, the dollar shows risk off. Unless the dollar starts dropping precipitously through the key levels I'm looking at, then I may have to change gears with the ES. However, I'm going to trade the underlying order flow we're seeing. I'm not going to call a top or a bottom. Order flow is clearly bearish. We have relative equal lows here in the form of sell side liquidity. And that is where I am favoring price drawing to. However, as I've said, I don't have a hardline bias going into this week because of all the extenuating circumstance that we're having to deal with as traders and speculators in the market. So going into this week, depending on where we open at, assuming we open near the closing price, I would not want to see price rally through these premium arrays. If we do rally through the bearish breaker and the volume imbalance, that would be problematic for lower prices. So assuming we open and rally through there, then we'll just have to get in line with what the market's showing us, and then that would be bullish order flow. And then that would more than likely be met with a dropping dollar. So then we would be back in our agreement with the risk on, risk off relationship that we look for to make what it is we're doing high probability. So what would quantify shorts for me is as long as we stay below these key levels, I will anticipate delivery down to the downside. Assuming that we find support inside of these levels and we rally through, then I will have to change gears and simply get in line with what the market's showing, which would then be bullish order flow. So as I've highlighted before, there are times as traders when we may not have the clarity that we always want, and we have to work within the gray area. So this isn't me calling both sides of the market. It's me simply being unsure going into this week with the high impact news drivers such as FOMC, and we'll just have to demand more information and be patient. So that's simply where I'm at right now. So downside objectives on the dollar or the ES, assuming we continue lower and the dollar gives us risk off, I will expect delivery down into the previous week's low and take out this sell side liquidity here, assuming we remain below these key premium arrays. If the dollar does drop and then we start seeing risk on, then I would expect price to find support inside of this order block and continue rallying higher. However, I'm not favoring that, but I will have to adjust with whatever we're presented in the marketplace. So with that being said, that's what I'm seeing here for the week for the dollar, interest rates, and the ES. So I believe that's all I wanted to cover. So now I will go into the dealing ranges and how to measure them top down. Okay, so for this part of the segment, we're going to be discussing dealing ranges and how to calibrate them on the respective time frame you are analyzing and how they complement each other on a top-down analysis. So to get started, we want to cover a few points. Things to keep in mind is each higher time frame dealing range will be parent to the subordinate dealing ranges, as well as you want to measure the dealing ranges from where the energetic run begins from, as well as marking out highs or lows at the extremes of the price legs that have taken out buy side and sell side liquidity. So what does that look like? Let's get right into it. So looking at this previous week, and then we'll show some examples from last week of how to use them top down and how to integrate them into your analysis for high probability analysis. So looking at the previous week here, we see that we have a dealing range from this high to this low, as this is the price leg that we were trading in when we rallied higher. So why would I use this high instead of this high here? There's nothing wrong with this high, but as I've stated in the introduction, I do like to measure it from where the energetic run begins from, which is right here. But if you use this high here, you still get a pretty accurate measurement of premium and discount. But I will favor this high to anchor it to. So we have an extreme here and an extreme here. This high is taken out buy side. This low has taken out sell side. So now we have a complete dealing range. And what will we expect before price delivers lower? A retracement up to a premium. Why is this? Because smart money won't keep selling or shorting the market in discount. It must offer a premium or expensive prices for the market to go lower. So now let's go down into our lower time frames and see how we can use this in conjunction with our lower time frame analysis so that we can have a clear picture on what price is likely to do intraday. Because as many of you guys may be thinking, well, I don't trade the daily chart. I'm an intraday trader. I am as well. So this is how you can use these analysis points top down to trade high probability. So now dropping down into a hourly chart, we still have this daily dealing range marked here. And I will actually transition over to the ES1. So this is the dealing range we're looking at on a daily chart. So now dropping down into a hourly. So this is the parent dealing range inside the higher time frame. So now let's go into our lower time frame charts as if we were doing our analysis. So one could look at this as a dealing range here, this high to low, and this is valid. So what would that look like? Okay, so this is the high, it takes out buy side. This low here takes out sell side. So by the definition, this would be a complete dealing range. So when we would see price trade up into a premium of this dealing range here, we would want to get short because price is in a premium to continue lower. Why would this be incorrect? Because remember what we started this off with. The higher time frame dealing ranges will always be parent to the subordinate dealing ranges. So while on a 4-hour chart, we see, okay, yes, this is a dealing range, and we're trying to shorten a premium, it's technically in a discount when looking at it in the higher time frame context. So that's why it's always important to do top-down analysis when looking at the charts, as the higher time frame dealing ranges will always hold more weight in your analysis than the lower time frames. So many people will look at this lower time frame 1-hour dealing range, try to short the premium, and wonder why they got stopped out. But that's because it's not a top-down analysis that's complete. So now looking at further examples going into this week, same thing. We want to measure the most recent price leg where the energetic run began from. And that would be this high to this low. So now this is the dealing range that we're working with on a daily chart. Why this high? Because it's where the energetic run begins from. It takes out a pool of buy-side liquidity. Why this low? Because it takes out sell-side liquidity. So now this is the dealing range that we're trading in on a daily chart. So now let's drop into our lower time frames and see how we can connect these analysis to determine premium discount in the lower time frames in conjunction with the higher time frames. So here we have our daily dealing range. So now let's look at the hourly dealing range. So here we have a significant high and then a significant low. So price trades into let me take this off so we can, okay. So this is our 1 hour dealing range, a high that's taken out a pool of buy side liquidity and a low that's taken out sell side. So price trades up into a premium, and then we should expect it to go lower and drop. No. Why would that be incorrect? Because we need to keep in mind our higher time frame dealing ranges. So it's going to want to likely deliver to a premium of the daily dealing range. Could this be a scalp here from premium back down to discount? Absolutely. However, if you are looking at this in your analysis, you always need to have the higher time frame dealing ranges on the higher time frame always in mind. So now looking at it down into a even lower time frame, like a 15-minute. So to look at the dealing range that we're in on an hourly chart now, we could use this high to this low. Why this high? Because it took out buy side liquidity. It's where the energetic run began from. This low has taken out sell side, and we have seen a dynamic move away from it. So now this is the parent price move that we're trading in. So now dropping down into a 15-minute chart, let's look at Wednesday's trading. And then for sake of context, let me mark out the midnight opening so we know where we're at in terms of price. Okay, so here we have the midnight open. So keep in mind while we're doing this analysis, the higher time frame 1 hour dealing range that we are still within. So we see the midnight price opens up here for Wednesday's trading. We see a displacement lower, and then price trades down into a discount. So to measure the dealing range on a 15-minute basis, I would look at this high to this low. We see price eventually trades up into premium, but let's focus more specifically on this morning session here, which we will highlight in. So this would be the morning session up to the lunch hour. Let's make this a light purple. Okay, so now let's drop down into a 5-minute chart. So keep in mind, this is the parent 15-minute dealing range that we're still within. But as we go down into the lower time frames, we need to keep in mind that there's graded price swings and that there's price legs within price legs. So while we are within this 15-minute dealing range here, there's also a 5-minute dealing range here from this swing high to this swing low. So let's take this off so we can see it more clearly. So one could say, okay, well, we would expect delivery to a premium. Well, on a 5-minute chart, we did reach a premium because we have a fair value gap in here. So we have this fair value gap in premium, so price traded from discount to premium, and then we rejected this premium level. But if you were only looking at the 15-minute dealing range, you wouldn't have had the context by which to understand why price was rejecting this premium level. So that's why it's always important to have the higher time frames in mind. So going back up to a 15-minute chart, let's do this once more. So we are trading within this dealing range now from this high to this low. So price is now traded up into a premium. So we should expect price to deliver lower, attack the relative equal lows, and discount. Why would we not favor that? Because we need to keep in mind that we are still inside of this parent 1 hour dealing range. So it will be more significant than the lower time frame. So it's going to want to reach premium of this parent dealing range we're in as opposed to this one. So that's how you could have avoided a potential stop out of, oh, well, let's get short in premium and attack discount. Because as long as you have the higher time frame dealing ranges in mind, you can avoid premature stop outs and trade higher probability. So with that being said, I think that'll conclude here this session of the teaching on dealing ranges. I hope this was helpful. I was having 3 or 4 questions on it, so I wanted to cover it in depth of how I measure the dealing ranges and how I personally use them and find success with these concepts, and how I use them in a top-down analysis so that I'm able to calibrate the dealing ranges on each respective time frame to complement my analysis. So now with that being said, we will now go to the Q&A portion of the meeting. And I know I've answered quite a few questions already, but we'll take a few more before we go ahead and close out. Thanks for watching, Chin. I appreciate it. So on dollar, do I consider that a market structure shift? Let me take a look. So the question was, do you consider the candle from March 7th to March 13th a market structure shift because it took the highs? So March 7th right here to the 13th. Okay. That's a good question. And yes, that could be interpreted as a market structure shift in the proper context. So assuming we were looking for lower prices, this would absolutely be a viable market structure shift and return to fair value gap to then get short. So this is why I personally am at a conflicted analysis, because as you've highlighted, yes, we have taken buy side liquidity and given the 2022 mentorship model. The reason I am not only favoring shorts is because looking at the weekly chart, price is still bullish, and this appears to me to be retracement down to a discount. But I've already shared what would qualify or negate a bullish or bearish setup, but this absolutely could be the 2022 mentorship model short, and this is why I'm personally 50-50 on my analysis. Assuming we continue accelerating through these key discount levels I've highlighted, then that absolutely would confirm that, okay, we have seen buy side liquidity purged, market structure shift, and now we should expect the discount of the dealing range we're in to be delivered to. So yes, that would be a valid market structure shift within that context. Absolutely. Yes, so let me take a look at EU real quick. The euro. So yes, the euro would be the same thing, just the inverse. Absolutely. So I think we are actually seeing a bit of an SMT here because I'm seeing here that the euro actually took out these lows and the ES or the dollar index failed to take out the highs. So we are seeing an SMT here. So where the dollar failed to actually make a higher high here, the euro actually did make a lower low. So that is significant. We've been monitoring this fair value gap here for some time. I've been monitoring consequent encroachment. We traded down through it, above it, and now we're down below it. So as long as we're below this fair value gap, I will favor lower prices. So we do have another fair value gap in here, a SIBI. So I will want to see how we trade inside of this key level. If we get above this fair value gap and then begin using it as support, and the dollar continues dropping, then we could be back in risk on territory where we are seeing lower dollar, higher foreign currency, higher indexes. So these are the key levels I'll be monitoring here for euro. Something to keep in mind though is we do have relative equal lows here. And as long as we are below this fair value gap, order flow will be bullish for me. However, assuming that if the dollar does drop below the key levels I'm looking at, then euro will more than likely rally through these premium levels. And if we do find support inside of these discount arrays, then I would look for higher prices in euro. So that's what I'll be looking for on the foreign currency markets. Taking a look here at the British pound. So the British pound actually did take out this sell side liquidity. Okay, so the British pound actually did take out the sell side liquidity and has rallied higher. So we are seeing potential, the beginning of bullish order flow here on the British pound. We are seeing price find support inside of this volume imbalance and bullish order block. The opening price. So we are seeing support inside of the bullish order block. If we do rally through the consequent encroachment of this wick is what I'll be watching. And then we also have a bearish order block in here. So assuming we continue finding support inside of these discount arrays and rallying higher, then I will expect the British pound to continue its bullish order flow. and that would obviously have to be in concert with a weaker dollar. So that's what I'm seeing here for the currency markets. Let me take a look at gold real quick. I know we have quite a few gold traders. Gold's been extremely bullish. SMT here with silver. Looking at the silver market, so it actually made a lower low here, and gold failed to make that lower low. So that's our correlated pair SMT divergence. So then after that, we've seen a strong rally higher. Remember, we talked about bullish order flow, up close candles should be traded through. We've seen that. And then we traded through this premium fair value gap. And then we found support inside of this level, which is bullish. Another thing I do want to highlight that I was monitoring throughout this week is looking at the fair value gap in here, measuring the consequent encroachment. Price was actually unable to trade below consequent encroachment. And as we know what that means price is extremely bullish, and price is likely to continue rallying higher. And we have seen that. So those are the technical factors that have led to the bullish gold, as well as all the fundamental factors that we've been discussing that have led to fleeing of the dollar and money pouring into assets outside of the dollar. What is my A+ setup? Yeah, let me cover that, and then that'll be the last question I will take for today. Okay, so going into the ES, as I said, I specialize in the ES. So my A+ setup actually formed this Friday in the PM session. So something interesting. Let me mark out the new week opening gap. So this is was my draw on liquidity. And this is something I wanted to share. This is how you can be wrong in your analysis and still make money. So this is the new week opening gap. So how could we have anticipated this would be a consolidation week? Because look how many times the new week opening gap was traded to. Once, twice, 3 times, 4 times, 5 times, 6, 7, 8. So the new week opening gap was traded to several times. And as we've discussed before, and as ICT's taught, this is indicative that we are in a consolidation profile, and we saw this transpire throughout the week. So once we've seen price just stagnating around this level, we know, okay, we're dealing with a tight range consolidation week, and we have to do surgical strikes and be in and out and very precise with our targets and objectives. So now to go into my A+ setup and what it is I was looking at. So for a bit of context, let's look at the New York lunch hour. So here we have 12 to 1 o'clock. So this is the New York lunch hour, the lunch macro. So let me mark out the time so we have our bearings. So the midnight opening, power of 3, open, accumulation, manipulation, distribution. And this is our new week opening gap, so keep that in mind. So what I was looking at in this previous trading day was lower prices, more specifically because we traded, I'm not going to mark those levels, but just keep in mind what we discussed earlier in the webinar where I was sharing my premium levels, which was the fair value gap, the bearish breaker, as well as the volume imbalance. And I counsel you to look in your own charts and see where these levels overlap with these. And we see a rejection of these key levels. So that was additional confirmation to expect lower prices. And as I said, my draw on liquidity for this day was this new week opening gap. It didn't hit it, but it was still a profitable execution nonetheless. And let me show you how this looked and how I managed it myself. So we see here, we have the opening at 8:30. So 8:30 opening price, manipulation above it, which we would anticipate if we are going to be bearish. So we see the market offers higher prices. This was also met with an SMT on the NASDAQ. So the NASDAQ actually took out previous day's high, whereas the ES was unable to. So I was already favoring lower prices because of the higher time frame levels in premium. And the SMT was just the final confirmation. That was the algorithm giving me the green light to, okay, we're going lower and expect lower prices. So we saw the correlated pair SMT, or correlated index SMT, at these highs. So the news driver came out at 10 o'clock. So price opened at 10, manipulated higher, and then dropped for the AM session. I personally was not participating in this. I had other things to attend to in my personal life, so I was not active in the AM session. For the PM session, I was though. So let me type this out. This is the lunch hour. So New York lunch. So this is our New York lunch hour. So what do we expect during the New York lunch hour? We expect it to attack the buy stops from the morning session. So price delivered lower. Retail is looking to chase that price lower. So anyone that was fortunate enough to be short, where are they going to trail their stops? Where all the books tell them to put it. All the books, the educators out there say, put your stop above the most recent swing high. So then the lunch macro is going to take out those people that overzealously place their stops, and then it's going to have the continuation for the afternoon session, which I did participate in. So the lunch macro runs out the AM session by stops, and then we look for our PM session expansion lower. So this is how I incorporate my time elements into my setups. So this is my A plus setup. So here we have the opening at 2 o'clock. Price. 2 o'clock. So the reason I look at 2 o'clock is because if we look at the 4-hour candle, that's the opening price of the 4-hour candle. So as I've highlighted to you all before, power of 3 is not something that's limited to a daily chart. It's on every single time frame, from the 3-month candle to the monthly to the weekly, all the way down to a hourly and 4-hour candle. So the reason I mark out the 2 o'clock opening is because that's the opening of the 4-hour candle. So we expect power of 3. So price opens at 2 o'clock, manipulates higher. This was also met with an SMT. So this is now where I'm going into my A plus setup. So we see the NASDAQ actually took out the lunch highs. The ES was unable to. So that's one confirmation. The other confirmation was the lunch macro took the buy stops. Why would it take the buy stops? So that it can continue lower. So who accumulated those buy stops in a premium? Smart money to ride the move lower. So as I said, when we started trading the afternoon session, I was expecting delivery down to the new week opening gap. So this was my ultimate draw on liquidity. Even though it didn't reach that, this was still a profitable endeavor. So we have the opening at 2 o'clock. We have our manipulation higher. We have the SMT. So now I drop into my lower time frames and look for entries. The draw on liquidity, my first objective, was the low in here, and then I was wanting to see this new week opening gap delivered to. So now let's drop into a 1-minute chart so I can show what my A plus entry setup looks like. So as I've highlighted here, we've had the SMT as well, where the NASDAQ actually took those highs, and then what this shows is this is a failure of the ES to get above these highs. And then we see a displacement lower below this low. So now we have a bearish market structure shift. So now we have a bearish market structure shift with displacement and a fair value gap. So now what do I like to see for my entry criteria? Personally, the PD arrays I like to use is the breaker and a fair value gap. So right here would be our breaker. And let me mark this in blue. Why would this be a breaker? Because it's the last down close candle before the buy side liquidity purge. Price then displaces through the lows, and then price trades back into it. So after the market structure shift, we have a fair value gap that I'll mark out here with the black lines. So we have a market structure shift, a breaker, and a fair value gap. So as soon as price trades back into this fair value gap and breaker, that's where I'm doing my short. Where would I put my stop? I would put my stop above this candle here. Why this candle? Because it's a bearish order block. Okay, so my stop loss would go here. Why? Because it's above 3 PD arrays. What 3 PD arrays? The fair value gap, the bearish breaker, as well as the order block. So if 3 PD arrays are overtaken, then your idea or the framework that you're working within is more than likely not valid. So we see price traded up here into the breaker at fair value gap. That's where I would have taken my short, and then I would have covered here in discount. So I would measure the dealing range that we're now trading within, and my first profit target would be discount. So the first discount level we get to would probably be this swing low in here. So first partial, second partial at the external range liquidity. And then, as I said, I was expecting the new week opening gap being delivered too. However, that wasn't necessary for this to be profitable, because as I trail my stop, I would have trailed my stop here. We have a bearish order block, fair value gap, and volume imbalance. So remember, as I've just highlighted, 3 PD arrays were broken on this move higher. So that more than likely means the framework or the bias that you're working within is more than likely in jeopardy. And then we see that price then rallied higher into the close. So this is just an example of my A+ setup, what I like to look for, confirmations and confluences. And this was also in line with the higher time frame bearish breaker, volume imbalance, and fair value gap that we rejected. So this is personally what I like to look for my personal high probability setup. So with that being said, I think that'll do it for this session. I really appreciate your guys' time for sharing it here with us. And thank you very much for you guys writing to me in the chat. And my apologies for the technical difficulties. I'm still a bit of a noob when it comes to OBS, so we're still getting the hang of it. So as we continue moving forward, we'll continue making the process more efficient and streamlined. So thank you all for your patience and for sharing your time here with us. And hopefully we'll be able to get my associate Tommy on for the next one. But thank you all. Have a great week trading. Stay safe.